You've done the research. You've watched the videos. You understand the waterfall, the preferred return, the fees. And now you're sitting in front of a deal summary, and there's a part of your brain asking, is this actually a good idea? That moment, right before your first wire on a passive real estate investment, is what this video is about. I'm going to talk about how to think about your first syndication, how much to allocate, what to look for in a first deal, how to calibrate your expectations, and the questions most first-time LPs don't ask until after they've already invested. Let me start with mindset. Your first syndication is not a retirement portfolio. It's an education. Not in a pessimistic way, you should expect it to return capital and generate returns. But the most valuable thing your first investment teaches you can't be learned from any video, what it's like to be a passive investor. What communication from a GP actually looks like. How distributions feel, and when they're late. What it's like to hold an illiquid asset for 4 years and watch a real estate cycle play out. That education is worth calibrating your expectations around. Invest an amount you can afford to have illiquid for the full hold, typically 5 to 7 years. Not because you expect to lose it, but because liquidity is genuinely limited. Position sizing for a first investment. The minimum on most private syndications is $25,000 to $50,000. Some are as low as $10,000. Some require $100,000 or more. A reasonable approach for a first-time LP, invest the minimum, or close to it. Not because the deal isn't good, but because your second investment will be better informed than your first. The minimum lets you learn without concentrating your capital in a deal that hasn't been tested by your own experience yet. As you build your LP investing track record, with a GP whose communication you've seen, whose reporting cadence you know, and whose numbers you've watched through at least one difficult period, it becomes appropriate to increase your allocation. If you have a significant amount to deploy, say, $250,000 or more, consider spreading it across 2 or 3 deals and 2 or 3 GPs. Diversification across operators reduces single operator risk more than diversification across asset classes. Choosing your first deal. For a first syndication, I'd prioritize 4 things over projected returns. First, GP communication record. Look for a GP who publishes investor updates publicly, on their website, their YouTube channel, their newsletter. The way they communicate to the public is a preview of how they'll communicate to you as an LP. Avoid GPs whose public presence disappeared when the market got difficult. Second, stabilized or light value add, not heavy renovation. Your first deal is not the time to underwrite a complex construction project. A stabilized asset with strong occupancy and a modest renovation budget is a lower complexity first investment. You can add execution risk to later deals as you get comfortable. Third, conservative underwriting. Request the deal's underwriting assumptions, rent growth, exit cap rate, exit timeline. Compare them to current market data. A GP who underwrote 3% rent growth in a market trending negative, or who assumed a 5 cap exit in a 7 cap market, is not underwriting conservatively. Conservative deals may show lower projected returns. They're more likely to deliver them. Fourth, a GP who will take your calls. Before you invest, get on a call with the GP. Ask your questions directly. How they respond to a first-time LP's questions tells you how they'll treat you when the deal has a rough quarter. Here's the due diligence checklist for your first investment. These are the minimum questions to answer before you wire. 1. What is the GP's full track record? Realized deals, deal-level data, projected versus actual returns. Not a highlights reel. 2. Is this GP full-time in real estate, or is this a side activity? A GP whose primary income comes from sources other than real estate management has different accountability than one whose business depends on their deals performing. 3. What is the financing structure? Fixed rate or floating? When does the loan mature? A floating rate loan on a 5-year hold with a maturity date in year 3 has refinancing risk that a fixed rate loan with a 5-year term doesn't. 4. What is the occupancy today versus at underwriting? A deal that underwrote 92% occupancy but currently sits at 78% is already behind plan before you invest. 5. What are the specific value-add steps and who is executing them? A renovation plan with specific unit counts, costs, and rent premiums is credible. A vague, light value-add with strong rent upside isn't a plan. 6. What is the debt service coverage ratio today? DSCR below 1.2x on a stabilized deal means limited cushion for any revenue shortfall. 7. What do other LPs say? Ask for references and actually call them. Setting expectations for your first deal. You will receive less communication than you expect in the first 6 months. Some GPs only report quarterly. Some reports are summary level, not detailed. This is normal and frustrating. Your first K-1 will probably arrive in August. File for a tax extension. Your CPA should know this is coming, tell them when you invest. You will not receive distributions immediately. Most deals begin distributions after stabilization, after renovation is complete and occupancy is at or near target. On a heavy value-add deal with a 6-month renovation, you might not see your first distribution until month 7 or 8. The hold will be longer than projected. Almost every deal extends. A 5-year projected hold often runs 6 or 7 years. Build this into your liquidity planning. None of this means the deal is failing. It means real estate syndications operate on a different clock than public market investments. After you wire. Keep a deal file from day 1. The executed operating agreement. Your wire confirmation. Every investor update. Every K-1. Review each investor update when it comes. Don't let 6 months of updates pile up unread. If something looks off, occupancy below plan, distribution suspended, vague explanation, ask a direct question. Build a relationship with the GP, not just a transaction. A GP who knows you as an engaged LP, one who reads the updates and asks reasonable questions, communicates differently with you than one who thinks you're just a name in the cap table. And when the deal exits, whether the return was above plan, below plan, or at plan, do an honest review. What did you learn? What would you do differently? That review, plus your realized return, is the primary data point for your next decision. Here's the summary. Your first syndication is an education as much as an investment. Size it accordingly. Prioritize GP communication record, deal simplicity, conservative underwriting, and direct access over projected returns. 7 due diligence questions to answer before you wire: track record, GP full-time status, financing structure, current occupancy versus underwriting, value-add execution plan, DSCR, and LP references. Set realistic expectations. Quarterly reporting is normal, K1s are late, distributions start after stabilization, holds extend. Keep a deal file and stay engaged. Your first deal teaches you what to look for in your second. The LP due diligence checklist, a full first investment guide, is linked in the description. Subscribe for the next one. We're going to go through the deal summary itself, the 10 numbers that matter, how to find them, and what they tell you. Thanks.